Welcome to my channel. If you're new, this is not what I normally sound like. I've been sick for about a week now, but I'm finally feeling better, so really it's just my voice. So don't think I'm pushing through this and putting myself at risk. It's just going to sound a little cringe on your end. It's going to sound like I've lived multiple lifetimes using Altria products. But really I'm feeling good, and I wanted to deliver to you guys today 5 stocks to buy from now through the end of the year, because we're halfway through the year. It's crazy. So it's time to dig in to 5 stocks that I have high confidence in with their future growth, ability to return profits to shareholders, and they will prove to be great long-term investments, I believe. So we'll get started with stock number 1, and really this isn't a stock, this is an entire sector, and that is REITs. I hold 2 quality REITs that I have high conviction in, and that is Vici and Realty Income. But this really can be any quality REIT. With the Fed holding rates high and possibly even raising them more and keeping them higher for longer than expected, the REIT market has taken a dive, but a rare dive that I do not expect to last for long, and that just means we get the opportunity to add shares at lower valuations. See, if you hold a REIT that is of quality, what do I mean by quality? Well, here's my quality checklist, and when I buy a investment, a stock, it has to check all these line items. If it does, then to me, it's one that I should have no problem buying. So while REITs are being suppressed by rates and not by specific business fundamentals, then I'll be adding. So let's take Vici as an example. Look at their financials. Remember, REITs have gone down with their stock prices, but Vici's revenue is going up. And we'll see right here, their net income is going up. And you want to look at year-over-year data. Now, long-term debt is high, but REITs operate on leverage, so this is not anything to be alarmed with. What you do want to factor in how you really value a REIT and its performance is with adjusted funds from operations. So really this is like with other companies, you'd use free cash flows. With REITs, you use adjusted funds from operations. And it's going up. And we can take that to another level with AFFO per common share, and it's going up. So this has a lot of financial metrics going in the right direction, even though the market is really suppressing REITs right now. So I think we are having that opportunity, like I said. And all I'll say is that if Vici collected 100% of rents on time throughout the entire pandemic, one of the worst things to happen to real estate, especially in Vegas, then I think they can manage through a high rate environment just fine. Now we're going to look at real quick, and this will be for every stock on here. This is from S&P Global, but they provide the analysis and estimate of the performance of this stock, and they rate it an outperform right now with the upside potential of about 24.58%. So this is for Vici, so definitely a buy in my books. I think this company long term is going to be an outperformer. Now next up, the next stock is Uber Technologies, ticker is UBER. Uber's multimodal offerings create stickiness, and Uber is the one-stop shop for all transport needs. In fact, everybody that I know that needs to have something delivered, like some food, they use Uber, not Lyft, not anything else. Uber is the dominant one out there that I see around me, but let me know if it's different for you. So Uber is well positioned also in the autonomous vehicle race, and that could mean no longer needing to pay drivers and save this company big. People love convenience. The one thing I will say with investments, if it has the convenience factor in there, you're already winning, because people love convenience, they can't get away from it, and it always wins. So I expect deliveries of meals, groceries, and convenience store goods to increase over time, along with ride services to get from point A to point B. I will say this, I think there's an opportunity here too with these ride sharing services. I have a friend that has epilepsy. I always thought it would be really cool if the government stepped in and created some type of discount, or maybe made it even free, some type of benefit for both the user and the company. So like Uber itself, that could really provide a service for people and individuals that really are unable to drive themselves, but really they're either having to choose between putting themselves at risk or paying a lot of money to get around all the time. So I really think if something like this develops, which I think it could also propel this business even more. So if any government officials listening right now, I think this would be a good one to put on your books for the future, to pass some type of help for those that need it, to get around and get things that they need. So if we look at their financials, revenue is going up, a beautiful line up. If we look at net income, they went from a loss now to an actual income, so that's good to see that it's swinging upwards. And then if we look at their long-term debt, it's staying relatively steady, so that's a good thing. Of course, going down would be even better, but going up is what we don't want. Now, with their free cash flows, this is going up over time. It kind of dipped last quarter, but the thing with free cash flows, if you see it go into the negative or go down, it's not a bad thing. That means that they're probably investing that money in a beneficial way that will help the company in the future. So you always want to look into it, not just look at some chart and be like, oh no, it's gone down. Well, maybe they're investing into something that is going to really boost the free cash flows in the future. Now, its two main risks are Google's Waymo, there's also Tesla, and also regulation around ride sharing. That's growing and becoming more of a pain in companies like Uber. But I think they already have themselves cemented pretty well in the ride services industry, as I only hear those around me use Uber, like I said, and not other companies like Lyft. Maybe it's different in your area, but in my area, it's pretty much dominant, and it's Uber. This is one I am actually highly interested in adding to my portfolio, so you might see it pop up someday. And with its analysis, it's actually in the buy range with an upside potential of 37.5%. So I think this is one that has a lot of potential. There are some risks that you need to consider, but might be worth at least putting on your watch list for now. The next company I'm going to talk about is Taiwan Semiconductor Manufacturing Company, or ticker symbol TSM. I think this will be a 1 trillion market cap company very soon. This company manufactures and sells integrated circuits and wafer semiconductor devices that are used for many things, such as personal computers and game consoles. TSM will benefit from internet giants designing their own data center chips, and TSM will earn higher gross margins, which is a great thing, than competitors thanks to its economies of scale and premium pricing justified by cutting-edge process technologies. So if we look at their financials, we'll see that they kind of have this little up and down and back up with their revenue, so it is climbing back up as the recent 3 quarters, which is good. Net income, similar story, but it still has yet to reach the highs of last year, so we want to see that grow, which I think it will get there. And then long-term debt is going up, so again, it's all how you look at it. Maybe they're taking out debt to invest in some things, because I know these companies are very CapEx heavy. But eventually we do want to see this go back down. We don't want to see a trend of debt going up. And then free cash flows, they've kind of gone up, down, back up. Last quarter dipped again. But again, free cash flows, they're probably investing heavily. That's why also that debt is going up. So I really think they're gearing up for a big push out of the high demand that I know we're going to see. So of course, there is a lot of competition, both foreign and here in the US, where the US government is providing heavy capital spending to companies like Intel to help them succeed. Regardless, TSM is one of the top competitors, and I do not think that will change anytime soon. So I think it's a very safe investment. And right here, you'll see it is in the buy range, but it has a lot lower potential upside at only 7.42%. So I think this is one that if it has a good dip, that's when I think it would be a good opportunity to add. So it might be one to add to your watch list to get into this sector and kind of capture that market. Next up is CrowdStrike Holdings, ticker symbol CRWD, the cybersecurity company that has market leadership in endpoint security. The security operations markets are projected to grow rapidly, and CrowdStrike will be one of the main winners here. Now, with their financials, this is beautiful. Their revenue is going up just like clockwork every quarter. Their net income went from a loss, now it's swung up to actual beautiful income. That is great to see. Long-term debt is staying relatively flat, so that's good. And free cash flows is going up, up, up. This is actually really good. I love this. Again, competition is the main worry with CrowdStrike, as other players like Palo Alto are making heavy investments in endpoint security. CrowdStrike has a tough job of staying ahead of new technologies to capture market share. With that said, CrowdStrike is positioned to keep its market-leading share in endpoint security, and I think there's plenty of protection demand to go around. Now, it's also in a buy right now, rated a buy from analysts, and has an upside potential of 14.88%. So if you do not have any type of cybersecurity exposure, I would definitely put this one on your watch list. It's a great company and one that I think has a bright future. Now, lastly, The last stock is Health Equity, ticker symbol HQY. This is the company that provides technology-enabled services for healthcare and spending decisions, most popularly known for its health savings account, which is the number one provider of these accounts. If my voice squeaked there, I'll say that again. It's the number one provider of these accounts. This is also my newest stock that I have added to my portfolio as I am very bullish in its future. The CEO has said its goal is to have as many health savings accounts as 401k accounts, and I believe they could get there. So with its financials, it looks beautiful. Revenues going up quarter after quarter. Net income swung from a net loss now to a beautiful net income, and it's going up the last 4 quarters like clockwork. And long-term debt overall is going down, and free cash flows is going up beautifully again. Great financials. This is one of the reasons why I also chose this company. Of course, its biggest threat is government regulation, and any change in the popularity of health savings accounts could spell trouble. But I see many around me choosing these HSA accounts, including myself, as they are very beneficial and can act as another retirement account, and they are a triple tax advantage account. I think these accounts will be a huge part of the options offered by employers, and I think many will choose these versus a traditional insurance plan. One I am betting big on, and we'll see here it's rated a buy with a potential upside of over 26%. So speaking of all these investments, let's look at my portfolio. You'll see here I'm up 18.47% overall. I have companies in the red and the green, so it looks like Christmas, or red and green chili as we say here in Albuquerque. But there you see Health Equity, it's up 3%. They report next week. They report their earnings next week, so I'm very anxious to see what happens, but I think it's all going to be good news. And yeah, if you have any questions on my portfolio, let me know. It's kind of been a little bit of a pullback with the REITs, and a little bit of the technology companies have also pulled back recently, but I'm very bullish on this, and I do want to sell out of the 3 stocks, that's AT&T, Warner Bros. Discovery, and 3M eventually, because I do believe I can get them in the green and then sell and then put them into some better investments. But yes, my portfolio, I share this with every single video, so be sure to subscribe so you can follow along, see if my strategies and tactics work. And also, let me know what you think of my 5 choices for June and beyond the rest of the year. What companies would you remove or add to my list? I'd be very anxious to hear. So with that said, I think I'll give my voice a rest now. Thank you guys for tuning in, and we'll see you very soon on Mark Arnold's Finance.